Everyone, welcome to the webinar. We are waiting for a few more participants to join. We expect to start in the next 5 minutes. So good evening, everyone. Let's get started. I hope I am loud and clear, audible. Can I get a quick confirmation on the Q&A box? Sure, thank you for confirming. So the webinar today is all about algorithmic trading. Right? You might have heard this term or you might be using it. But today what we are going to do is break down this term, understand what is algorithmic trading and how it is going to be useful in our day-to-day life, especially if you are a trader and investor, right? So it's not necessary that you need to have a programming knowledge to be an algorithmic trader, and that is what we are going to focus today. So this webinar specifically caters to audience which do not have any programming background or do not have any experience on programming using any language. So we will look at how you can use some simple platforms that are available in the market and automate your trades based on some strategies that you build. And we will also reveal some of useful things for you towards the end of the webinar. Right. So the agenda for the webinar is to understand the basics of what are the different kind of asset classes that you can actually trade. What is algo trading, right? What is the need for it? how is it different from the manual trading that people generally do. We will also look at one of the algorithm that is designed by the Investor Academy, uh, and how much of, what is the performance of that algorithm over the years. We'll also look at how we can go ahead and back test or define a strategy so that we can work with these algorithms in live market. And towards the end, if there are any questions, we will take those questions and answer all of them. So first of all, basically you would say, what are the different kind of assets that you can trade in the market? Right? Normally people trade in equity, they trade in commodity, they trade in forex. So we are specifically talking about the equity segment, which is related to just the stocks and the indexes, right? We are not catering to the commodity market or the forex market for now. So for the equity market also, you can divide it into two parts, which is basically you're buying the shares of a company. So simply buying and selling shares of individual companies based on whatever analysis you have done, or you get some news, you go ahead and buy a part of that company, right? So if you have a trading account, you can simply, let's say, I want to buy 100 shares of Reliance, expecting it is going to go up in the next 5 months, in the next 6 months. So I'll keep those shares in my holding, and probably when they give me some amount of profit that I expect, I will release them or sell them. But if you are holding it for a longer duration of time, company also pays you dividends. It is like just paying interest on the shares that you are holding. That is what many people do when it comes to Indian market. But at the same time, to mitigate the risk, to hedge their investments, what they also do is work in the derivatives market, right? As the name suggests, derivative, it is basically deriving a value out of some underlying assets, right? We'll look at in the next slide what are the different underlying assets on which you can work on the derivatives market. But there are two types of assets that you can trade. One is called futures and one is called options. Futures is where, as the name suggests, you are expecting the price in future. So if, let's suppose, I want to buy the future of State Bank of India, so I have to decide a price, that up to what price that future might go in the recent days, and then you can buy or sell that. So it's basically a contract that you are trying to execute at a predetermined price and date, that up to this date I'm expecting the price to go to a certain level, and then you can trade. The benefit of working with the future is that the margin requirement, the amount of money that you pay to hold a stock in equity and to do that same in future, is significantly less. So assume that Reliance is trading at around 3,000 rupees a share. If you want to hold 100 shares, you need a 3 lakh rupees capital. But at the same time, if you want to hold 100 shares in the futures of Reliance, you might not need 3 lakh rupees. You probably need around 1 lakh rupees. So the investment is less, but on the flip side, it has an expiry. That means you decide a date, that up to what date you want to hold that future. And at that date, whatever is your profit and loss, you'll have to take it. So you cannot hold this forever. It has some expiry because it is a predetermined date that you have to enter. And if you want to reduce that risk further, you can trade in options, which is one of the most useful segments that is traded to mitigate the risk of equities. Because here the margin requirement, it depends on the type of trading strategies you are building, but it is very small as compared to buying and holding equities. What are the underlying assets that you can trade, and what are options? So mostly we are going to talk about options because we've developed a lot of strategies on option trading. So we'll speak about what is option trading and how you can work with that. So what are the options? Options basically tells you that they are some regulated financial securities which you can buy or sell for an underlying asset at a specific price on or before a certain date. So options gives you the right to buy something at a future price on a future date. Right? Think of it as a real estate investment, that you like a house that you'd like to buy. Let's say the house price is around 50 lakh rupees as of now. So you contact the seller and say, okay, I'm going to give you 2 lakh rupees as a advance, but I'm going to buy that house after 6 months, not now. So you're deciding a future date that, okay, I don't have 50 lakh rupees to buy that house. I will have that money, or I will take a loan in 6 months and I'll buy that house in 6 months. The seller is giving you that 6 months, in return asking for a advance which is non-refundable. That is what we call as premium, that you are paying some amount in order to block that deal. You are blocking a deal to buy a house 6 months in future at a fixed price of 50 lakhs. So the seller is at a risk that what happens to the price of the house if it increases. So let's say after 6 months, the price of the house is 55 lakhs. The seller has already sold it at 50 lakhs. So they are obligated to sell. In that case, they are going to have a loss because they are already into a contract to sell that house in 50 lakhs. But for a buyer, you can say you are already buying it at 50 lakhs plus the advance that you have paid. If the current price after 6 months of the house is not 52, which is the price plus the premium you have paid, you are not going to exercise that contract. You'll say, okay, what is the point in buying the house when the market value has depreciated? So you'll take that 2 lakh loss and move on. So that is what are options in general, right? So I'm not going to give the detailed explanation of what are options because that is something that we will talk about later in the follow-up sessions. But for now, a basic understanding of options, you can say it's something that you want to buy or sell at a certain price at a future date. And there are 3 types of things with options, which is the type of option you're buying, which is referred to as a call or a put. In simple terms, if you are looking at something that will increase in future, right? So let's say for any stock, you think that the price of that is going to increase in future. Then the type of option you should hold is call. If you think the price of a certain underlying asset is going to decrease in future, you can buy a put. So for the expectation of increase in price, the type of option that you can exercise is a call, and vice versa, a put. That's one terminology related to options. What are the type of different options that you can trade? Then you have strike price. Strike price is the determined price, right? So let's say today Nifty is trading at around 23,000. Next week or next month, you're expecting it to go to, let's say, 24,000 or 25,000 or whatever price. So that is your strike price. At what price you are expecting the market or the underlying asset to be at a future date. And expiry is that date. Normally, expiries can be of 2 types, right? Either a contract can be on a weekly basis or it can be on a monthly basis. The maximum that you can take is a monthly contract. So every month, the contract will expire and you have to re-enter into the contract if you want to trade options. So the kind of underlying assets that you can trade with options are stocks. Normally, any stock that you see on the stock market, not every stock will have an option or a derivative to it. But most of the top capital stocks you will find that can be traded on derivatives. You can trade indices like you have Nifty, you have Sensex, Bank Nifty, Then there is mid cap Nifty, Fin Nifty. So there are many stock indices also that you can trade. You can also take the derivatives of currencies. Like every time you see how is the Indian rupee compared to a US dollar, trading somewhere around 83 rupees, right? How's the Indian rupee compared to a Great Britain pound or a Japanese yen or to a euro? So in India, it is legal to trade only 4 currency pairs. It can be the Indian rupee with a US dollar, a Great Britain pound, Japanese yen, or a euro. So you can trade derivatives only for these 4 currency pairs. Right? Similarly, just like stocks, you can determine a price where that value of the currency would be at a certain date, and then you can trade that. And you can also do that with the commodities like gold, silver, crude oil, any metal, any agricultural commodities and all. So all of these can be your underlying assets. Underlying asset refers to what you are going to trade in the derivatives, what asset you are going to take an option or a future. So when you're trading options, you can trade it on a regular basis, like a daily basis. You can buy and hold it till the expiry. So it is a decision that is taken on various kind of analysis. But tell me something, if you are already into this market, if you are already a trader, is it possible for you to look at, let's say, all the 50 companies that you have in Nifty 50 to identify if there is a buying or a selling opportunity in one of the stocks? How many companies technical or fundamental analysis you can do given a point in time? So if I sit at 9:30 a.m., the market opens at 9:15. So let's suppose I sit at 9:15 and start looking at what should I buy, what should I sell. So it's impossible for me to look at the entire market and say, okay, this is where I can buy or this is where I can sell. Because for a human, analyzing, let's say 10, 15, 20, or even 50 stocks simultaneously is going to be difficult and probably impossible. And that is where the algo trading comes into picture. Right? As the name suggests, algo trading. So algo trading is, I'll just skip these slides because that is something that we've already covered. So what is algo trading? Algo trading is a form of automated trading, you can say, wherein instead of a human, a machine or a system is going to place the trades for you. So you can decide a strategy. Let's say there is a quarterly result for a company that is being announced, and you expect that quarterly result of the company to be very positive. That means they have grown in revenue, they have generated more net profit. So you're expecting their share prices to go up. So what you will do is, before their quarterly results, you will go ahead and buy some stocks. Now you're purely basing your decision on a speculation that, okay, I'm expecting this to go up. But doing that, you miss out mostly to look at the historical trend. That what happened to the last 10 or 15 quarters where the company declared the results? Did it increase? If it increased, how much did the market move? How much their share prices increased? If the revenue went down for a quarter, what was the impact on their share prices? So not many people analyze that. You only look at future outcome and try to take a decision, and which is called as a human bias. And 90% of the traders make a mistake there. Human bias and sentiments. That's when people start trading, they make losses. And that is what is the advantage of algo trading. So it's a simple form of automation where you define certain rules that, okay, that if the share is trading above this price, I'm going to buy. If the share is trading below this point, I'll probably sell. So you will define some simple rules based on whatever analysis you do on the historical data. You look at some technical analysis, or you do some fundamental analysis, you do some time analysis of the stock and decide that, okay, these are some of the rules that I think should work. And you just simply automate that. So the biggest benefit of algo trading is it reduces the human bias and emotions. And in a way, it's not just reducing, it is eliminating it completely. Because you are asking the system to take the trades or to enter into the market and exit whenever the rules are met. So first of all, it is for working professionals like a blessing in disguise, because you don't really have to sit on your system 6 hours a day to look at the market, to look at the charts and say, okay, this is where I want to enter and exit. You define certain rules, just give 10-15 minutes in the morning and just deploy the algo and it will do the rest for you. It will automatically pick up trades when the rules are met, and based on the strategy that you have developed, you will probably get the same profit and losses that you see in the historical data. Because one of the golden rules of trading is based on the assumption that market conditions are not going to change significantly unless there is some drastic change, right? Like there can be some events overnight where the market might change significantly, but most of the times the market is going to move within a range that you see in the historical data. And that can always be identified through different strategies that you can develop. So the term algo trading has a very, a negative term for many people, that this is something that not everyone can do. It is actually for anyone, right from someone who's starting with investments or who want to do trading on their own without any programming knowledge. If you have a programming language knowledge like Python or R, then it's going to be a little more beneficial, because then you have more opportunities to apply predictive modeling, artificial intelligence, and identify trends and patterns more frequently and with more accuracy. But even if you don't have any programming language, still you can develop strategies that can be profitable over time. And we will see one of those examples today, where I will show you one of the strategies which is very simple to work with, does not involve any form of coding, and it usually works well given any type of market, be it a rising market, be it a falling market, or be it a sideways. You can define strategies for all the type of markets. You can define the strategies for the type of trader you are. If you want the trades to be closed within the day, or you want to keep that trade for the next couple of days or till the expiry, you can define strategies for any time period. And algo trading basically helps you with all of these things that you see on the screen at the moment. So it can do that efficient automation without the coding skills as well. You can automate all the trading tasks. It's accessible to all. And in India, it is growing like anything now. Many people are adapting to it so that they don't have to spend a lot of time in front of the system, and it is very useful for eliminating the human bias and emotions, as I said. So with human bias and emotion, what happens? You carry your losses. But with algo trading, because these are rule-based systems, it cut down your losses. You can rapidly deploy this. That means you can come up with some own strategies by analyzing the market. If you have some knowledge on technical analysis, charts, and how you can read the chart and all, you can develop your own strategies pretty quickly. And there are many backtesting platforms now available in India, which can be used, where the data is available. All you have to do is just go ahead and code your strategy based on a UI or with Python programming and get started with it. You can backtest how your strategy is working on the historical data, and then you can start deploying it. And that is what artificial machine learning is all about. So it's not just about trading. This is something that is done in every line of the business. You look at any industry, they are now adapting data science. They are moving towards the machine learning, predictive modeling, and automation, right? So many decisions are now taken on the basis of data rather than perceptions. So that is something that you can apply to trading world as well, right? So how many trades you can say is currently done in India based on algos? It's only 15 to 20%. So that percentage is very low because the availability of the platforms was not there. It has rapidly increased in the last 1 year or so. The data was not available to develop strategies and to test them. But with the platforms that are readily available now, and more people gaining knowledge and understanding of algos, this percentage is increasing rapidly. But at the moment, it stays at around 15 to 20% of the traders who do trading in India, they are using algo trading for it. But it is significantly lower than the percentage that you can see in the countries like US or some countries in the Europe or Asia, where it can range from 55 to 75%. So more than half of the traders around the world use algo trading for their investments. Now, since more and more platforms are available, it is growing at a rapid pace in India, and that is what we are trying to leverage. That why not automate the trades, build some rules so that we can spend more time on the other productive tasks rather than sitting on the system for 6 hours and just looking at the charts, right? So this is a quick summary of how algo trading is different from manual trading. So on the algo trading, it can be automated based on some predefined rules and algorithms that you develop. While in manual trading, you have to sit on your chair for 6 hours, look at the charts, do technical analysis, and all your trades are based on intuition. You're just simply expecting if the market is going to go up or down. And one of the biggest difference is the execution time. With algo trading, the execution is in microseconds. But with human trading or manual trading, if you want to take a trade, you'll have to first go ahead and add that stock or the asset into your watch list, go into the buying or the selling screen, enter the quantity, and then click on the submit button. And during that process, you might take, let's say, 5 to 10 seconds, and within which the price can move significantly. So you might not get an entry at the right price, which is going to give you either a less profit that you expected or more losses, because the price at which you will buy or sell something might not be the one that you expected, as there was a 5 to 10 seconds delay in the process of taking that trade. While algo trading takes that within microseconds. You have defined all the rules already. As soon as the rules are met, takes the trade instantly. So there is less chance of deviating from the entry and exit prices. Algo trading can analyze hundreds and thousands of stocks at the same time. So if you define an algorithm to download the data for, let's say, 100 companies for the last 5 years, look at where we should do a buying or a selling. You can define an algorithm for it, and it can do that efficiently. Identify patterns pretty easily. But to do that same on the manual side, it will require a lot of efforts. Looking at 100 charts is not possible. You cannot go back 5 years and see what are the patterns developed. On algo trading side, if I talk about 2-3 years back, there was a significant investment required in terms of the platforms and the technology that you need. Now with more companies that are coming in and helping, so on the automation side, you don't really need to invest a lot on algo trading side. So it is just a case of, maybe around 500 to 1,000 rupees a month as the charges, and you will be able to do algo trading automated without any coding expertise. That's the major difference, where algo trading is very beneficial over manual trading that you generally do. So if you look at the results of one of the proprietary algorithms that we have developed, so this is a result of a trading algorithm that we've developed, and this result shows you what is the return generated by that algorithm over the last 5 years. So in the year 2020, it generated a total of around 117%. In the year 2021, it was profitable. In the year 2022, 23, and 24 continued. So this algorithm, what it does, it takes a trade on the Nifty and Bank Nifty indices, does option trading, and it's an intraday strategy. That means you do not carry your trades to the next day. Any strategy that you develop similar to this, you have to test it on the previous data and see if it is working or not. And this is something that we have also deployed live in our client accounts, and they are very satisfied with it. And because it does not have a history of making losses, that does not mean it may not give you losses. But as it is said with every investment, you have to stay invested. You have to trust your system. Even if you see losses in a couple of days or months, you have to stay invested and trust it. At one point in time, it is going to give you some profits. And that's what you generally do with any investment like mutual funds. You invest in mutual funds today, who knows, the portfolio will be negative or a positive tomorrow. It fluctuates. Sometimes it is negative, sometimes it is positive. But what is recommended? You stay invested and you keep adding to it through systematic investment plans like SIP that you do. You probably invest 1,000 rupees, 2,000 rupees every month in a mutual fund. And over a period of 5 years, 6 years, 10 years, you start looking at a substantial return. And that is exactly what you should do with trading. Many people take trading as a gamble, that I will come and double my money in a day. That is not possible. You are going to lose the entire capital. But if you treat it like a system where you can invest and generate a consistent income over a period of long duration, then you can definitely be profitable. It is not for the short-term person. Because even if you see, this algorithm is generating somewhere around 7 to 8% a month consistently. And that is something that you can expect if you have a very strong strategy that is working on any kind of market. Right? So from 2020 to 2024, you can see that the market has moved in all type of directions. You have seen COVID, where the market dipped 50%. We've seen the recovery from COVID. We have seen a lot of events happen from 2020 to 2024, where the market was very volatile, going up, down, ranging from 5% to 10% in a day. But still, these kind of strategies, if you develop, you can see that there are only a couple of months where it actually was in loss. For almost most of the time in the last 50 months, it was profitable. Profit can fluctuate, the loss can fluctuate, but as I said, what is more important is staying invested in the market. You can develop any kind of strategy, you have to trust it. And one other thing, for developing any strategy, none of the strategy will work in every kind of market. While this result is not just one strategy, this is a combination of multiple strategies that I'm showing. That if I'm deploying, let's say 5 or 6 strategies together, some will give me profit, some will give me losses. What I need to make sure is the net is my profit. And this result is on a basket of strategies where we've deployed around 2 lakh rupees capital to deploy this. So you have to see what kind of strategies works in a rising market, what kind of strategies works on a falling market, what kind of strategies works when the market is not moving up or down, it's remaining sideways. And you have to create a combination. Just like if you understand about predictive modeling, you look at the historical data and see what kind of patterns are developed in the history, and you're expecting the same kind of patterns to develop in future too, right? So that is what these kind of strategies extract from the historical data of various companies that you want to trade, and they build a system where they take decisions real time in future. So you don't really have to sit on your system manually doing this trade. The system will take care of it itself. And nowadays, many of brokers that you see, like the most popular broker in India right now is Zerodha, and all the other brokers too. They are all giving you the APIs for free, except for Zerodha, who charge for the API. All the other brokers give you trading APIs for free. That means you can develop your own algos and deploy them without any charge if you have a programming knowledge. But if you don't have a programming knowledge, still you can write an you can still write an algorithm based on a interface and then deploy it. Right? So let's see if there's any questions that you guys have so far. And write down your questions, whatever questions you have. So what are the fees you are charging? So we'll get to the details of the fees and the course details that that we are offering towards the end. So you'll get that answer. Can you show the interface and the working use case? Yes, that is the next step. I'm going to give you a demo of a working strategy and how it can be implemented without any programming knowledge. What is the minimum investment? So see, it depends on your appetite. Normally, you would say if you want to work with options, the minimum investment you should have to have a stable income is somewhere around 1.5 lakhs. But even if you have a smaller capital, like let's say about 50,000, you can still work on algo strategies. Normally, the strategies that you develop on algorithms need a capital of somewhere around 50,000 to be more profitable or to be at least stable. Will the algo trading work on react in the market crash? So if on a given day the market crash, it will simply take a stop loss. So when you're trading, risk management is one of the most important things. So if there is a day where the algo has taken an opposite position to the market and the market is not moving in that same direction, then simply it is going to take the stop loss and stop the trades. It will then identify the patterns again the next day and will continue to trade. But as I said, it might give you losses consecutively 1 day, 2 day, 3 day, or maybe up to a month. But you have to trust your system and stay invested. And over a long period of time, you will see the results. Here also, you can see on this page, in 2020, the maximum loss that was occurred was around 37,000 rupees on a capital of 2 lakhs, which is somewhere around 15%. But at the same time, the returns generated was around 120%. So the maximum drawdown, the last line that you see is the maximum loss that ever happened in that year. So it's not that any strategy will always give you profit. It might give you loss, but you need to continue the process. You need to trust that process and remain with it. What are the pros of algo? What are the cons? So on the cons, we can say that one of the biggest con is the technology itself, right? There can be some technological glitches because of which the algo might not execute, right? So let's suppose I'm deploying an algo on a server. I'm taking a server and deploying the algo. What happens if the server is down? There was an opportunity, the rule was met, but the algo did not take a trade because the server was not running. If I'm deploying a strategy on my own system, what if the internet goes off? What if the laptop goes out of charge and I don't have electricity at my home? So there can be various ways in which algo trading might not work. It's mostly dependent on the technology. It also depends on the logics that you are applying, but that is a human bias again. So if you think that a strategy is working in historical data, then only you will be deploying it. But your logics has to be strong. So to develop the right algorithm, you have to understand the market a lot. numbers are from backtest or real trades. So these numbers from 2020 till 2022, these are all backtest. From 2023 to 24, this is, you can say, real trades. Developed this strategy, backtested, it worked well. In 2023, we deployed it, and then it's continuing from there. So the last 15 months, 16 months results are real trades. Strategy, you first backtest and then you implement. So let's go ahead and look at a demo on the backtesting platform. Now, what kind of strategies we can develop? I'm just going to give you a basic example, right? So let's say, tell me something, which commodity is cheaper in Middle East than compared to India? Can you think of any commodity that is cheaper in the Middle East, let's say Dubai, as compared to India? Oil, but you cannot go ahead and buy oil from Dubai and come back to India with it. What you can go and buy from Dubai and sell in India? Gold is one of the commodity, yes. One of a popular technological thing, I can say a phone, iPhone. Maybe iPhone costs less in Dubai and as compared to India. So if someone is going there, we can ask them to get that for us and probably sell that in India at a reduced price. This is called arbitrage. Arbitraging is buying and at the same time selling that different region. So the strategy basically that I'm going to explain is on option trading, where I will not hold any position. That means I'm going to buy and sell something simultaneously. I'm buying and selling something simultaneously, trying to get the benefit of the price fluctuations. That if there is any difference in the price, I am most likely to make money there. So let's see how it is done. So let me go to the backtesting platform. Let me share that screen. So the backtesting platform that I'm going to use today is StockMock. StockMock is a platform where the data is readily available for the past, and you can just simply go ahead and deploy any kind of pre-built strategies, customize them, or you can test your own strategies too. So this is basically a backtesting platform. It's not a automation platform. This is where you can test any strategy that you're developing or you think that is going to work in the market. Now, as I said, I'm going to show you an arbitrage strategy wherein we are going to buy and sell something simultaneously, and we will try to understand or generate some profit from the price fluctuations. So what I'm doing is I'm showing you the results of this strategy in April, like whatever happened in this month alone, right? You can go ahead and test it on the past data as well, and it will work. But before that, before I show you the strategy, I want to understand from you, or let me see if you have answered that poll. One of the question I answered in the poll was, I did not ask the question. So let me ask this question. What is the expectation of returns that you have from algo trading? How much money you are ready to risk and against which you are ready to earn in market? So give me a return on a monthly basis. How much return you want on your investment through algo trading in a month? Your expectations. Yes, hedging can also be done with algos. 10% return, okay. 50,000, all right. 15%. So your fair expectation is If your strategy is very robust, it can generate somewhere around 5 to 10% a month. You should not expect that you can double your capital every month. That's very risky, and ultimately you'll end up losing your capital completely. If you are developing any strategy which is giving you a 5% a month as well, you can treat it as a very good strategy, because 5% a month results into 60% annually. And that's something that you can expect from a good mutual fund too. None of the other assets will give you that much of return consistently year on year. So for me, you can say a fair expectation is you can generate somewhere around 5% to 10% a month. And that is also over a period of time. Not every month you will find that. Some months you will be profitable, some months you will lose money. But if you take an average at the end of the year or at the end of 2 years, you should be profitable. That is what I showed you on the screen. Right? Now let's say, for example, based on this strategy, I want to risk 1% of my capital and 1% I want to get. So I want to gain 1% of my capital, and I'm ready to lose 1% of my capital every day. So my risk to reward ratio is 1:1. That means whatever capital I'm going to deploy for this strategy, I'm expecting the returns of 1%. At the same time, I will take a loss maximum of 1% for that day. I will not exceed that. And the strategy that I'm going to show will take a capital of somewhere around 50,000 rupees. So the loss of 500 and the profit of 500, wherever it reaches first, that is the end of the day for me. The strategy is, whenever you come in the morning, you see that during the first 15-20 minutes, there is a huge fluctuation in the market. Based on the global events that has happened, impact from the global market, you see the first 15 to 20 minutes is a very high volatile market. It's very fluctuating. So it is always better that you let the market settle down, right? Do not enter into the trades whenever the market is opening. Do not get into the market at 9:15 or 9:16. Let it settle for the next 15-20 minutes and then start trading, because that is when you will also know the direction of the market pretty well, right? In the first 15 minutes, is the market going down? Is it going up? What is the status of the global markets and all? So you'll be able to identify some trends. The volatility in the market will also become stable. So I always prefer to trade after 9:30, because that's when we will see some stability. So let's say I show you the results on the 1st of April this month. I am at 9:30 in the morning. So this is, as I said, a backtesting platform. So the historical data is available here. And we are looking at Bank Nifty. The price of Bank Nifty at 9:30 on the 1st of April was somewhere around 47,562. So what I will do is, I'll simply go ahead and sell a contract for the weekly expiry. So that means for that week expiry, I'm going to sell a contract for both call and put, right? Two types of assets that I mentioned in my presentation, that there are calls and puts. So I'm simply going to sell. But since it is arbitrage, what I'm going to do is, in the next week's contract, I'm going to buy the same thing. In the next week contract, I'm going to buy the same thing. This is the kind of payoff chart that you see, right? So it's giving you an indication what will happen if the market moves upside or it moves downside. So the first thing that you see here, the margin that is required, that means the capital that you need to execute this is around 50,000. What we have done, we've sold and bought the same prices, but in different expiries. And this is called as calendar spread. So I'm going to take the benefit of the spread in the prices by buying and selling them together, but at different expiries, different contracts. So selling is done in the recent week expiry and buying is done in the next week expiry. So you have more time, but it is always going to be an intraday strategy. So I'm going to exit from this trade wherever I reach my risk or the reward. So 1% is the risk to reward. So if I'm deploying 50,000, I'm expecting this strategy to give me 500 rupees or take 500 rupees from my capital every day. As long as the market stays within this green zone, you are going to be profitable. If it moves outside the green zone, then only you will have losses. But this is something that is plotted at the expiry day. We are not going to wait until the expiry. For Bank Nifty, the expiry days are Wednesdays. We are taking this trade on a Monday. So we have 3 days to expire. So let's see how this trade would have gone after 9:30. So at 9:30, I entered this position, paid 50,000. If I go 15 minutes, so at 9:45, this is giving me a loss of 90 rupees, which is around 0.2%. If I go 15 minutes again, at 10 a.m., it is giving me a profit of 66 rupees. At 10:15, still profitable. If I go 15 minutes like this, keep checking what is going to be executed first. Am I going to get my 1% profit or am I going to get my 1% loss? Yeah. So we entered at 9:30 and at around 1:45 on Monday, it gave me around 1% profit. So that was the risk to reward ratio. We had 500 rupees profit, 500 rupees loss. Approximately, we've got that. If I go further, it will keep fluctuating, but as soon as it gives us that target, we will exit from the trade, right? We will not hold it because we wanted 1% from that strategy on a day. We got that return. So that is the end of that day. So 1st of April, we made a profit, 1% increment. Let's do the same thing on 2nd of April. See if it works on the 2nd of April. We are going to do the same. At 9:30 a.m. in the morning on the 2nd of April, I'm going to sell the current week and simply I'm going to buy the next week. So the similar kind of plot. Let's go 15 minutes and see if we are making profit or we are in loss. At around 1:15, it's giving us a profit of 1%. So we should ideally exit here. Right? If you keep it further, there might be some more profit, but that is up to your risk. And that is what we are going to do in the future sessions that we will have. Understand money management and how we can take more profit than 1%. At the same time, reducing all the losses. So 2nd April also we got 1%. We hit the target. Similarly, let's do that same on the 3rd of April as well. Right, I'll take one more example. Same strategy deployed on the 3rd as well. Let's go 15 minutes. See, within the next 15 minutes itself, we got our profit of 1%. Monday, Tuesday, we waited till around 1:30 to get the profit. On Wednesday, which was the expiry day of the contract, we got our 1% within the next 15 minutes only. And this is something that we can automate, right? Now, we don't have to take these trades manually. We can define a rule. Whenever the time is 9:30, go ahead and buy and sell these contracts. I can write a Python program to do that. And I can also do this with the automated platforms. Like StockMark is a backtesting platform. There are some platforms where you can actually execute the trades too. So you just have to deploy your strategy. You have to define the rules, right? These are all rules that at 9:30 a.m., there should be my entry. What should I buy? What should I sell? And what should be the profit and the stop loss? As soon as the profit or the stop loss is reached, it will take that trade and exit. And you can test this for as many days as you want, and you will find a win rate of more than 70% here. So if I'm risking 1 rupee in a 1 rupee return, and I am making money 70% of the times, that means I'm losing 3 rupees, earning 7 rupees. So that's giving me like 4% return on an average. This is a simple example of one of the strategies that can be deployed. But again, none of the strategies are always going to work. So you have to keep improving and understand the recent market trends and keep optimizing your strategies. This is something that is probably working in the recent and the current market, might not work in future. It might not have worked in the past, but at the moment it is working. So we'll continue to do that. As soon as it start giving us a streak of losses, we'll see why the strategy is not working and we'll try to improve. Maybe we'll change the prices, we will change the time, maybe we'll change our risk to reward ratio. So that's how you optimize. Right? So you cannot work with the same thing over and over again. You need to change because market situations are not always going to remain the same. This was one example of a strategy that I wanted to share for the day, which you can also backtest, but with a disclaimer that not every time you will find all the things to work. Any questions that you have from whatever we have seen so far? The final announcement is about the course that we're going to launch in the Investor Academy related to trading. This is a extensive course where we're going to teach about the basics of stock market. If you are already a trader, probably this is the first two things you will already be aware of, but we'll give you the introduction to technical analysis, what kind of indicators you can use in order to read the charts, and not the ones that are generally used, right? So when I say indicators, these are not the moving averages or MACD or RSIs that you see in the market. We have custom coded indicators and machine learning based indicators that can be used. So we're going to give you all those resources, show you how it works with the charts, how to read them properly. And we are going to do all of this with TradingView, which is one of the charting platforms where you can apply a lot of things. Read price action, how the price is moving, what are supports levels, what are resistance levels, what should be your right time to entry, right time to exit, and all of that stuff. How to implement all of these strategies. If you are a programmer, how you can do that using Python. If you're a non-programmer, how you can use some automated platforms to do that. Introduction to options trading and all, how the pricing of the option works, how you should decide your risk management. And we will also be discussing and developing simultaneously more than 25 strategies that can work in various kind of markets. So we'll try to develop and create 25 strategies that works best in combination when you look at any kind of market situation. We will also be having live market sessions. So if someone is interested in trading and doing it live, then we all will have those live sessions, and we will also be a part of a community where other traders will share their analysis, and we will also post our analysis. So you get more information on the daily trends and patterns. For this month, this course is going to be absolutely free, and we'll reach out to you all individually to give you the details of it. So we'll drop a link on the group of a form which you can fill, and we'll get back to you details of the course, right? When it is starting and how you're going to sign up for it. That's pretty much the end of the webinar. If there are any questions left unanswered, or if you have more questions, feel free to ask it on the Q&A box. We'll have the next webinar planned soon with more details on strategies, and this time for programmers. So today we looked at no-code platforms. Next time we will do a webinar for programmers who are interested in Python programming and using that for developing these kind of strategies. The platform free to experiment? No, I believe, because they have also invested a significant amount of money in generating that data, because when you talk about the backtesting data that is available, Nifty charges you more than 15 lakh rupees a month to get that data. So these companies have also invested in getting that data and building platforms. So they are not going to give it for free, but the charges are nominal. The stock market platform that I showed, it charges you somewhere around 300 rupees a month. So you can sign up for 300 rupees a month and backtest any strategy that you want for the entire month. Python and data science learned help will here? Yes, definitely. Because that's the objective of algo trading. So you see, finding patterns, finding what happened in the past and taking that decision into future. And data science is one of the best things that can do that. So if you have learned data science, if you have a knowledge of Python programming, you can get that data from the brokers API, and then you can automate it. You can build machine learning models. You can also use these large language models like ChatGPT APIs and all to find out when is a good opportunity to buy or sell in the market, identify which stock you should trade, which asset you should deal in. So there can be a lot of things that you can do with the science, with the data science help. Final round of check. Any more questions before we close? So this webinar was recorded. If for some reason, if you were not able to pay attention, the recording will be shared on your email. The email that you have used for registration. We will also share the recording on the WhatsApp group if you have already joined the WhatsApp group. If not, you can join it. We will do all the announcements there. So we look forward to have you in the team and keep following us so that you get to know more about the different ways of working with the market. So that's it for the day. Thank you so much for joining. Have a great evening, guys. See you all in the next webinar. Bye-bye.